Welcome to the Explainer. So, let's jump right in. Have you ever actually stopped to think about the literally monumental scale of the Indian government's finances? I mean, we're talking about billions of dollars translating to trillions of rupees constantly flowing in and out to build infrastructure, run services, and, manage a nation of over 1 billion people. But how is all of that actually managed? Like, what stops the whole system from just descending into total chaos? Well, it all comes down to a dense, incredibly meticulous rulebook that governs every single rupee. Today, our goal is to demystify this exact rulebook. We're going to look under the hood of the Indian bureaucratic machine and trace the actual life cycle of a government rupee.
This right here is the foundation of our entire explainer today, the General Financial Rules, or the GFR. It was originally laid out in 2017, but has been continuously updated right up to 2024. And as Rule 1 makes absolutely clear, these rules have total, unquestionable authority. They apply immediately to all central government ministries, departments, and any attached or subordinate bodies. You see, when you're dealing with public money, the stakes literally couldn't be higher. This document exists to ensure that every single coin collected from the public is treated with the utmost respect, bound by incredibly strict oversight, and deployed effectively. Think of it as the definitive operating manual for the government's wallet.
Okay, let's dive into this. Here is our roadmap for today. First, we'll cover the financial rulebook. Second, collecting government funds. Third, formulating the budget. Fourth, controlling the expenditure. And finally, handling losses and fraud. Let's start with Section 1, the Financial Rulebook, anchoring the bureaucracy.
So, before a single rupee is ever collected or spent, there's this foundational philosophy that guides every single financial decision a government officer makes. And honestly, I absolutely love this concept because it takes this massive, faceless bureaucracy and instantly humanizes it. This is Rule 21, which sets the standards of financial propriety. It explicitly states that every officer must exercise the exact same vigilance with public money as a person of ordinary prudence would exercise in respect of expenditure of his own money. I mean, really think about that for a second. Before we even get into complex accounting or multi-million rupee contracts, the primary anchor for the entire rulebook is simply looking at an official and asking, hey, would you spend your own hard-earned money this way? It demands that expenditure shouldn't be more than what the occasion demands, and that absolutely no authority should use their power to pass an order to their own advantage. It is literally common sense, enshrined as the highest rule of law.
Now, while that philosophy is pretty simple, the actual execution requires some serious precision. Early on in Rule 2, the GFR busts some of that classic bureaucratic jargon to help officers logically structure how they acquire things. Take the CapEx, or capital expenditure model. This is your traditional route. The government buys the goods outright, handles the maintenance themselves, and disposes of it later. But contrast that with the OPEX, or operating expenditure model. In this setup, the government doesn't actually buy the asset outright. Instead, the seller provides the goods, takes care of the maintenance, and the government just makes staggered payments over the life of the contract. Clearly defining these terms from day one ensures everyone across the government is speaking the exact same financial language.
Moving right along to Section 2, collecting government funds, securing the receipts.
So, we've established the philosophy, but how exactly is the government mandated to gather and protect the money that comes in? Well, according to Rules 7 and 9, the government has a strict, non-negotiable duty to ensure all receipts and dues are properly assessed and collected. But where does all that physical money actually go? It goes right here, the Consolidated Fund. This is the primary fund of India, and it's legally anchored in Article 266 of the Constitution. Every single bit of revenue raised by the government, whether we're talking taxes, dividends, or loans, must be brought into the government account without delay and credited here. I really want you to grasp this. The Consolidated Fund is essentially this grand national vault where the public's money safely lives once it's collected.
Now, what's really interesting about this slide is how the government determines what to charge you for specific services. Rule 47 covers non-tax revenues, specifically user charges. When you pay a fee for a government service, that amount isn't just arbitrarily pulled out of thin air. No way. The rules dictate that these charges must be scientifically calculated to recover the current cost of providing that service, plus a reasonable return on the initial capital investment. Furthermore, they have to be actively linked to price indices and reviewed at least every 3 years so they keep pace with inflation. It's a very carefully balanced equation designed to ensure the government doesn't just operate at a massive loss when providing specific services to the public.
Up next, Section 3, formulating the budget, planning the expenditure. All right, so the vault is full, and now we need to look at how the government formally plans to spend all that money it just secured.
Everything here revolves around a very strict 12-month clock, which is defined in Rule 42. The financial year always kicks off on April 1st and ends on March 31st. But notice what happens at the very end of this timeline. Rule 62 states that any funds provided during the financial year that are not utilized before the close of that year simply lapse. Poof, they vanish from the department's disposal. And why? Because the GFR strictly forbids a rush of expenditure in the closing months. If a department hasn't managed its money wisely throughout the year, they aren't allowed to just recklessly dump the remaining funds in March just to zero out their accounts. It actively forces steady, planned, and prudent spending throughout the entire year.
But, of course, before any of that spending can actually happen, it has to be officially approved. Under Rule 43, in accordance with Article 112 of the Constitution, the Finance Minister is required to present the annual financial statement, which is what we all commonly know as the budget. This document lays out the estimated receipts and expenditures right before both houses of Parliament. It details every single program, every scheme, and every debt repayment for the upcoming year. This is absolutely crucial because it ensures total democratic oversight. The public's representatives literally have to look at the math and give the green light before that national vault can be opened.
Which brings us to Section 4, Controlling the Expenditure, the strict guardrails.
Okay, so the budget is passed, the money is allocated. Now begins the absolute most critical phase, controlling the expenditure. This is where the GFR puts intense, heavily monitored guardrails on the money as the actual spending kicks off. You can't just run around handing out blank checks. Rule 26 places immense personal responsibility squarely on the shoulders of what's called the controlling officer. This individual is legally bound to ensure three major things. First, that every single rupee spent is strictly in the public interest. Second, that the expenditure never ever exceeds the budget allocation. And third, that there is an adequate control mechanism in place to actively prevent waste and loss of public money. The rules don't just ask them to casually monitor things, they demand proactive prevention of any irregularities.
And this brilliantly illustrates just how rigid those guardrails really are. Rule 57 lays out the excruciatingly precise bureaucratic machinery required just to draw funds for an already approved project. A drawing and dispersing officer can't just ask for a bag of cash. First, in Step 1, they must prepare completely distinct bills for different types of expenditure. Then, for Step 2, they have to perfectly classify the accounts, breaking it all the way down from the broad major head to the highly specific object head. Finally, in Step 3, they literally must calculate and enter the progressive total of expenditure up to date right there on the bill. It is a massive paper trail fortress designed from the ground up to catch errors and prevent anyone from accidentally overspending their exact allocation.
And finally, Section 5, handling losses and fraud, when things go wrong. But, what happens when that fortress is breached? This final section kind of shifts the tone to a high-stakes detective procedural. Let's look at the strict protocols that get triggered when public money or property goes missing. 50,000 rupees. That is the magic number outlined in Rule 34. If there is any material loss or destruction of government property above the value of 50,000 rupees due to suspected fire, theft, or fraud, it triggers an immediate, mandatory police investigation. Boom. It's no longer just some internal paperwork issue. The matter is immediately handed over to the authorities, and all department officials are legally required to assist the police to get to the absolute bottom of the suspected crime.
Let's move to and see how this builds into a much wider response known as the defalcation protocol. Mapped out in Rule 33, this is the strict process for handling embezzlement or severe losses. Step 1, an initial report has to fly up the chain of command the very second a suspicion arises. Step 2, a formal investigation digs into the exact cause, the total extent of the loss, and, critically, which specific rules were neglected to allow it to happen in the first place. Step 3, a final report goes to higher authorities and the statutory audit officer. And finally, Step 4, the matter is disposed of. Now that either means officially writing off the loss or, and this is key here, recovering the cash directly from the culpable officials. Which really brings us to the ultimate consequence. Rule 37. This completely drives home everything we've talked about today. It clearly states that an officer shall be held personally responsible for any loss sustained by the government through fraud or negligence on their part. Actually, scratch that. It goes even further. They are also responsible if their negligence allowed another officer to commit fraud. If you fail to protect the public's money, the government will come straight to you to make it right. It is a very stark reminder of the sheer gravity of public service.
So the crucial point is this: the entire life cycle of a government rupee is bound by a massive, interconnected system designed to enforce that concept of ordinary prudence. From the day a tax is collected to the day it's ultimately dispersed for a public project, the general financial rules demand that officials treat the public's money with the exact same care, vigilance, and respect as they would their own. It really makes you wonder, especially looking at this intricate level of accountability, how prudent is the financial rulebook of the organizations you interact with every single day? Think about that for a bit. Thank you so much for joining me on this explainer, and as always, keep asking the right questions.